All right. August 7th, let's do a quick market update of what's going on here, guys. My name is Alex Dubidari, and as you know, I am the database trading guy, Statistical Edge, and I want to explain to you today why I prefer doing that, and also that it does not mean that you ignore narratives in macro. You actually need to understand these things as well, because you want to understand when to stay out of the market, or also when you can just simply continue to trade your patterns, right? And make sure that your patterns are actually structured in the right way. So you have the statistical, edge, you have the positive expectancy, and you can just, work your play out and continue to make money, especially over the long term with your trades. So let's look at the market here. So we see, and this is the US 500, so S&P 500 on CFD. So you have overnight pricing here. Market has not opened in the US just yet, but you can see we have a bullish recovery going on here. Nonetheless, if you look at from the bigger move down, that's not even 50%, I believe, already that we've seen here. So these recoveries, they are, in my opinion, extremely dangerous. Why are they dangerous? Because they are fragile. So that recovery needed to be a lot more a V-shaped recovery for me to believe that it is a recovery. Otherwise, there is a big risk that you get suckered in and then boom, it goes down. That's what market makers do. That what big players in the market do. They pretend something. They might push the market up themselves so they get the liquidity of the people in. All the people invest now. They get back on the bandwagon, buy the fucking dip, right? And then they put in their big short orders and take your money with them. So that's why these levels don't convince me just yet. And same actually on the crypto side of things. Like you see Bitcoin, the recovery is there. Like you cannot say that there isn't a recovery. We're also trading here at the high of the day, but nonetheless, obviously we're far, far, far away. So this is just like, don't forget, when you close shorts, you essentially buy, right? So there is no opening and closing on a market. There's only buying and selling. So you have a short exposure. You need to close it by opening buys, right? You always need to settle your exposure. And that move down could just be literally the profit taking of the shorts closing out. Doesn't mean that that's it. From a short perspective. Like I said, from a levels perspective, for my taste, we're far too much down. You can see like we're testing now this support area that we were trading around before. That was, I believe, when Germany was selling their Bitcoins. So that's why, guys, if you look also then at the narratives that are in the market, for example, like what is driving the market at the moment, and this is what actually makes me pay attention to it. So first of all, we have the Bank of Japan. It sends a dovish signal now. Dovish signal means it's like, hey guys, don't worry. We're not going to increase our interest rates anymore. Like, sorry, don't worry about it. We might actually cut again. And, so basically they're trying to be accommodative again. So the deputy governor sent a strong dovish signal in the wake of historic financial market volatility. So we call this jawboning. So basically they pretend, they say something just to get a market reaction. And of course, market reacted. Stocks rebounded, all good, right? Like just buy the dip, we're going to the moon, right? Well, let's see. Printers coming. That's the hope now that the market has. Like the central banks will come to the rescue of the markets. But hey guys, keep in mind, what we've seen in a drop so far is really not that big. It was very fast and violent, but it's not like nowhere near the COVID drop where we had the last emergency meeting and rate cut, or 2008, or like it's not even close to that. So to expect and assume that the Fed will just like, overreact while having a history of late reaction, right? Remember when they said like, inflation is transitory? They kept that narrative on for so long until inflation was shooting and boiling over. And now they're holding the high rates, saying like, inflation is not down good enough just yet. So to expect that printers coming, by the way, that picture is so fucking cool. Jay Powell here, and if you are a little bit into Games of Thrones, I haven't seen it in a long time, but it's just funny, I don't buy it. I don't. And that's another thing that makes me actually not buy it, because that's what banks do. They put out reports that are wrong, that are intentionally trying to manipulate market participants. Because again, banks, big players in the market, they need liquidity. Remember, when somebody sells, someone else needs to buy, or the other way around. And as long as buyer and sellers are not met, prices move, right? That's essentially what it is. So, and now that JP Morgan says institutions bought the dip while retail panic sold aggressively. So retail sold $1 billion worth and institutions bought $14 billion worth. Sorry, like honestly, if that would have been a case, like a 14-1 in and out, why is the market price not reflecting that? You know, so that to me is I would see it like as a manipulative story to tell people, all good guys, come back in, to sucker people back into the market. That's how I see it, you know. Again, I might be wrong. My analysis is what it is. So I need to also be flexible with my analysis or with my opinion. That's extremely important as a trader, by the way. If you are too headstrong, you know, you will lose. You need to be adaptive, smart, fast, and disciplined, you know, and obviously knowledgeable. So then you will survive. So that's why, to me, that's not something I would see as a positive. Actually, I would see this as a red flag, because also, if you look at the economy in general, you see like layoff announcements, 2024, 15, like a lot of companies are laying off. What it means is that, yes, the Fed may be pushed into cutting rates because they have two mandates, right? Price stability and labor market. Now, labor market seems to be, you know, all these good NFP numbers that we had 6 months the whole time, they were revised down every other month again. So they were fake, more or less. Plus, whatever jobs that were created were government jobs most of the time. So it's a completely nonsensical number. And last time, we had an even negative number. So yes, the job market is struggling. That's a fact, you know. And if it struggles even further, it may push the Fed into cutting rates. But is cutting rates immediately a positive stock market? Historically, it's the opposite. After cutting rates and a reinversion of the yield curve, markets typically sell off. Plus, don't forget that this is not like a COVID standstill kind of situation. This is literally people having no money anymore, no jobs anymore. So how is an economy supposed to work? How are these, you know, PE ratios of all these companies going to play out if their earnings are going to go down? So that's why I'm thinking there is a bigger dip potentially to come, unless, look, price action is king. Never fight the tape. When the tape continues to show up and actually breaks important levels, I'm going to forget about all these narratives. But right now, because we are a bit in an in-between situation, you need to weigh your options. You need to think of like, if this happens, I'm going to do that. And if that happens, I'm going to do this. Be prepared, because if you're not prepared, if you haven't laid out scenarios, position sizing, entries, exits, all of these things before, then you will do mistakes. You will be driven by fear, by greed. You will not think of any rules, position sizing, levels. None of these things will matter anymore. And that's why you lose money. That's why most people, this is actually treating trading like gambling. And you want to avoid that at all costs. Don't do that. And, you know, also right now, the market environment is just like, it's a gamble. It is a gamble. Like, look at this. This is SMCI, like, okay, it went up 16% on earnings. And then just minutes later, it traded 9% down. That's 25% swing in a big stock. So, you know, is that an environment that you could trade in reliably? It's a gamble. You might be on the wrong side. You might be on the right side. Chances are you'll be on the wrong side. And so that's not an environment that you want to expose yourselves to crazy risks, right? The risks that you want to take in trading, they need to be quantified. You need to have a clear reason, and that's why I'm the data guy. That's why I do Statistical Edge. And within all this turmoil that is going on here, I'm just following my script. So I had a trade here that I was looking at, and that I actually communicated in my group also yesterday, in fact. And that's on the Kiwi CAD. So the interesting part was like, okay, we were at the lower part of a swing here, and we entered at 81,895. So actually, I can pull it up here as well. NZD CAD. Forex. The trade's actually doing quite well. So we entered at 81,895. So let's just say around here. You see, we got the whole swing here. And why did I enter this trade? What was the reason that I entered this trade? Well, first of all, again, this strategy that I'm trading here has a statistical edge. It has clear rules and is back-tested, forward-tested, and that's why I'm having confidence and trust in executing it. And I know that the risks that I'm taking are very well within the rewards that I will be reaping, right? So here we have on a weekly, the alpha trend indicator that I, like my indicator that has tons of code in it, a lot of like all my years long of experience of how to actually determine the trend. There's a bunch of things in, also like speed of candles, size of candles, like a bunch of things actually. On the weekly, we're having a buy signal. And if we also look on the daily, we had the same thing. So we had a good confidence as to like, we have an ongoing like bullish trend here that we could look to re-enter on a dip. And that's exactly what we did. And that's the interesting part, we entered when most retail traders were short. Again, like I know it sounds arrogant, but you want to trade against the dump money because the dump money is gambling. Everybody's short on a crowded trade. I have my clear rules. I have my own, sophisticated tools that I use that tell me buy. And that's exactly what we did. And that trade is now up around 90 pips at the moment. The position size, obviously, everybody needs to decide this based on their own account and the risk per trade that you take in. And that's looking just like a beautiful trade. So this is how, even within all this turmoil, within all this craziness that is going on, when you have a method that is statistically sound and that is, it doesn't matter. It does not matter. You do not need to worry about the environment when you do that. But also, when the environment is too much turmoil, for example, any stocks or crypto strategies right now, I would not necessarily want to look at those or even get involved with the yen. So, because there are risks that are outside of any regular patterns. So, but the market is big. There's so many opportunities there. And this is proof that you can, even within all this craziness, just continue to run your statistical edge method and make money. So, that's my video for today. If you like what I'm doing, subscribe, like, share. Let me know what else I should do videos about, and I look forward to seeing you next time. Thank you.